Hello and welcome to BQ Prime. A very good morning to all the viewers. You're watching Stocks in Focus, and I am Neeral Bhatia. Two companies that we will be discussing today is one, Chalet Hotels. Clearly, this is on the back of the way numbers have panned out and what is the story going to be going ahead. And the second one that we are looking at is AGI Greenpac on the back of earnings as well as the capacity expansion that they have been focusing on. But let's start off with Chalet Hotels. It's interesting to see, clearly the kind of growth that we've seen. It has been a strong quarter. The growth story seems to be on track as well. Let's welcome in our guest and understand, what is his view and how does he look at the future. Sanjay Sethi, MD and CEO at Chalet Hotels, joins in. Sanjay, good morning and welcome to the show.
Good morning, Hiral. Pleasure being back.
Always a pleasure to speak to you. Overall, Sanjay, it has been a strong quarter. The growth story seems to be absolutely on track, and the operating margin improvement has been absolutely impressive. If you could help us understand, has it met your internal expectations, and how have you looked at the quarter?
So, Hiral, it's been again a very satisfying quarter. I think it's now 5 quarters on a trot where we've been able to, perform well. It just instills significant amount of confidence in the industry and the business that we are in. The real story about hospitality is that the demand-supply gap is significant and will continue to impact in a positive way all the existing players and the inventory that exists on the ground. We've had a quarter where we churned about 318 crores of revenue, which is roughly 27% higher than the same quarter last year. Our EBITDA was a little under 130 crores, which is a 48% growth on EBITDA. And on the profit before tax, we've had a 2x growth on that side. And this has been supported by some very strong hospitality performance. We break up the performance on the room revenue side, for example, which is 2/3 of our business. Our average room rates are up 21% compared to the same quarter last year. Occupancy is up 200 bips. It's at 73% versus 71% same quarter last year. And as a result, the RevPAR, which is a blend of occupancy and rates, is up 25%. And this has been happening quarter on quarter. We expect growth to continue. I would also like to highlight that Q2 is typically the weakest quarter for the business and the industry, especially the business hotel segment of the industry. And therefore, we expect Q3 and Q4 to continue to perform better than this quarter, which will result in higher revenues and improvement in EBITDA margins too.
Right. So with all of that said and done, how is the ADR versus the RevPAR looking like? Because clearly, both of them are absolutely correlated. Now, the RevPAR has seen a good growth. Do you think you will be able to maintain that double-digit ADR as well going ahead?
Yes, we see no reason why not. We see several quarters of double-digit rate growths ahead of us. And therefore, we see the industry growing at double-digit rate of growth for the next year or so, a couple of years actually. After that, it may or may not slip into inflationary growth, which will happen on an annual basis. But next 2 years look very, very strong. And my confidence is driven by the fact that the supply side will continue to remain muted, especially in the big cities over the next few years. We expect the supply side to remain muted for the next 4 years, actually.
Right. When you talk about the occupancy as well, Sanjay, clearly this quarter, it's partially driven by the new Hyderabad hotel with 168 keys, which was opened in June 23. That is operating at 100% occupancy. Any similar properties that will help you improve the occupancy rate going ahead in the current financial year?
Well, if you look at the breakup in our presentation that we shared earlier, we've actually had a 300 bip improvement in occupancy for the Mumbai metropolitan region. So majority of the growth has actually come out of Mumbai and the region around it, including Vashi. The other cities, which includes Hyderabad and Bangalore and Pune, have grown by 100 bips. So that's gone up from 71% to 72%. And therefore, clearly, the business is solid all across the cities that we're present in. Hyderabad, 100% occupancy, but it's a small share of the total pie of the portfolio. So it won't impact it so much. But it is always good to have 100% occupancy in a hotel at rates which are very encouraging rates too.
Right. The other thing is, from a strategy perspective, Sanjay, industry peers have been focusing on an absolutely asset-light expansion route, whereas Chalet has chosen the route to grow the hotel rooms, office rental portfolio with the next, say, 3 to 5 years. And this is going to be through the ownership route, right? How does that augur for you, and how are you seeing it vis-a-vis what the industry peers are doing?
So this has held us well over the last 2 decades. There's no reason why it won't hold us well in the years to come. Does that mean that at some point in time we will not consider having our own brand or not look at an asset-light route? Whilst we don't have any specific information to share with you, but it is an option that's open to us, which can then be incremental to the growth that we have already planned at some point of time. But this continues to deliver high returns to us on the back of some very smart investments in great locations, and we'll continue to leverage this opportunity.
Okay. And between the rental business and the hospitality business as well, how are you seeing growth and contribution pan out from here on?
So there's a finite growth to the office business because we had spare land and FSI available. So we are basically sweating our real estate asset with an alternate asset class, and therefore develop the office assets, which are complementary to the trade demand for the hotel. And in turn, the office asset itself has the spin-off benefit of the hotel brand and thereby premium rental yields. So they both work well together. But at the end of the day, we have only finite FSI space on existing land parcels where the hotels exist. And at some point in time, they'll get capped off. There may be 1 or 2 opportunities here and there, but our growth strategy is around hospitality, whilst we'll continue to close and complete the existing projects at hand on the office side also.
Right. So when you talk about rental and annuity segment as well, if I'm not mistaken, a 1.2 million square feet leasable land is what you have. And the occupancy stood at around 57% in the second quarter. Do you think that's the normal, or will you see an improvement at that end?
No, that'll improve significantly because what you're seeing is we were at 80% before we opened this partial building in Bangalore. And therefore, the sudden jump of opening up a building has created that feeling that the occupancy is low. But that's because occupancy takes time to build up, typically 1 or 2 quarters. We will get to 90% occupancy on the overall 1.2 million portfolio in the next couple of quarters. So there's no concern on that. It's just the at what point of the cycle of development and opening of the building we're looking at. So not concerned with that. We are targeting to have 90% occupancy in the total 3 million square foot of office space that we're ultimately going to have.
Right.
2 million.
So from an expansion, so Sanjay, to add to this, from an expansion perspective, if you see, from the previous conversations and what we've spoken earlier as well, around little over 800 to 850 rooms is what we're seeing that could be added by FY27, right? Leasable commercial office space expected to reach, I think, little over 3 million square feet. And for all of this, what is the kind of capex that you're looking at? How long do you think, and how much revenues will it add to the pipeline if you have to look at the next 3 to 5 years?
While I would not like to share forward-looking numbers on the revenue side, but we've already shared with everyone the pipeline of hotel rooms that we have, which is roughly 870 odd rooms. But when I say pipeline, I'm saying that these are actual projects under construction now, or on advanced design stage. But that doesn't mean that we'll necessarily stop at that 870 rooms. Our BD team is a very active team. We're hoping to add a couple of more projects every year to this pipeline. So we'll continue to grow the hospitality portfolio as we move along. 870 is only a placeholder for now as projects underway. As far as the capex that we're going to spend right now, I think the next 3 years or so, we're spending roughly around 900 crores of future capex on the work under progress.
Okay. And Sanjay, from I know you don't want to give forward-looking statements from a revenue perspective, but clearly the CAGR that we've seen in the last 3 to 5 years, do you think it will be better than that from here on? Because there is a slight mismatch in terms of demand and supply. So there is a provision wherein rates further could go high as well in terms of room rates in the next 12 to 18 months. Does not seem to be a situation where the room rates could stagnate or inch lower. So taking that perspective into consideration, will the CAGR growth of the last 3 to 4 years be matched or will be way higher than that?
So I think I would tend to ignore the last 3 or 4 years of CAGR for a simple reason that we had COVID. So one COVID thing brought everything down pretty dramatically. And then the ramp up came off a low base. So whilst we might be growing at 40, 50% over the last 2, 3 years, I don't think that's a realistic growth rate that you can expect. I think double-digit growth on same-store basis for the next couple of years is very much on the cards. In addition to that, we will potentially be adding more assets to the portfolio. So that growth will be over and above that same-store growth that we will have. And we've got a couple of office assets that come into play. We've also got one residential asset, which was on hold for a very long time, which is now moving very rapidly to completion. And sales will start on that very quickly. And this is a build to sell. So once we finish this sort of inventory of residential, we'll be done with it. We have no plans to get into residential anymore going forward. But this was a historical asset.
Right. Last question, Sanjay. World Cup. How well has it augured for the hospitality industry?
I guess in bits and pieces. I've never believed in basing businesses on one-off events. Whilst they have their own benefit, every year something or other happens. And if you really look at World Cup, there's one match happening every day, which means, and in one city in such a big country. So one city every day may get the benefit of the World Cup match. Audience or spectators coming in, teams coming in, media crew coming in. But does not make or break businesses. I think what we need to focus on is steady source of business. And that's where I think Chalet has done extremely well. We've obviously had the benefit of the World Cup audience and teams, etc., at our respective cities. But that's not something I believe is the backbone of the business.
Absolutely. It is a short-term phenomena as well. Thank you, Sanjay, so much for joining us on the show. It's always a pleasure to speak to you, get insights, and clearly impressive growth that we've seen as well in a quarter, which is seasonally a weak quarter. And from a stock price perspective as well, with regards to where Chalet Hotels is concerned, on a 6-month basis, the stock has seen returns of almost around 50% that has come in there. And on a yearly perspective, very similar. So the uptrend with regards to Chalet has actually started from that May, June, July period. And that uptrend has continued. The third quarter is expected to be interesting as well. The kind of capex expansion plans that the company is looking at, all of them put together, are expected to be pretty strong, and the industry is on a strong footing. But moving on, another stock that we will be talking about is AGI Greenpac. This has been an interesting company to look at as well, because if you see AGI, in the last 6 months, the stock has actually more than doubled. Investors invested in this counter have made returns of little over 100 and nearly 125, 1.3 times, I would say that. And on a 1-year basis as well, strong numbers that have come in on this counter. Now, AGI Greenpac, if everyone's wondering, what does the company actually do? This is one of the companies which manufactures glass bottles, PET bottles, caps, etc. for beverage industry, mainly a packaging company that we are looking at. Joining us on the show to discuss more about the quarterly earnings is Mr. Rajesh Khosla, CEO at AGI Greenpac. Rajesh, good morning and welcome to the show.
Good morning.
Rajesh, a pleasure to speak to you and have you on the show. Firstly, overall, how has the season been? Because that's the key question that works for all bottling companies, beverage packaging companies. Has the number met your internal expectations in the second quarter?
Second quarter results are already out. We had a board meeting yesterday, and the results have been very fabulous. They are very encouraging, and the things have moved very fast. We have grown in quite a big numbers, both on the revenue side and on the profitability side.
Right. Rajesh, October, one of the hottest months that we look at, and that is the time when usually the packers, packaging material manufacturers, all of them face that demand supply constraint because the supply is at the peak. The demand, I beg your pardon, is at its peak, and to match that with the supply is always a push and shove kind of a situation. How is it panning out in terms of the third quarter now?
Typically, we have a seasonality in this business, and particularly there are two type of products. If on a seasonality point of view, I talk about on a one side of product which are more typically related with the summer months, and the other which are more related with the winter months. For example, the liquor industry, they are more in demand in the winter months, and the beer industry and the soft drink industry, they are more into the summer months. So if we back calculate, so I think October, November, December is the right time when in the summer months requirement, they start picking up because you have to supply them the bottles. They will fill the bottles, they will have a supply chain, they will stock it in their warehouses, and finally it goes to the consumer. So October months and the third quarter is always a better month, and the fourth quarter is the best quarter in the year. Second quarter, to be very honest, is always a slow, but even in the slow quarter, we have done reasonably well. Year on year, there has been a growth of 20% on the revenue side, and year on year, the profitability or the EBITDA, it has grown by almost 60%.
Right. So Rajesh, clearly, if I see the revenue mix, glass containers, 89% of the revenues of the company come in from glass containers. You are doing other, products as well, which do cater to the agro industry, beverage industry, which is non-glass, or even the pharma industry, which may be non-glass, the retail portfolio. Any plans on expanding that side of the business? Or you think it's the glass industry that will be dominant in terms of your business?
Glass industry is dominant even in our present business setup. I can say 90% of our total revenue comes from the glass. Only the PET business and a closure business, they are complementing the glass business. So that is the reason we are there in the total spectrum of the requirement. Our PET business is reasonably small, but our closure business, though it is small, but it is growing at a very fast pace. Because whatever, whether it is a glass or a PET, you need a closure to pack the bottles or to pack the containers and to go to the market. And in the closure side, a lot of technology is involved, a lot of new trends are involved, and this industry is picking up very, very fast. So we are moving on the upside of the curve in the closure industry, and we hope that in the times to come, there will be multiple times of growth we are expecting in the closure side of our business. Glass is our core area, focus area. We believe in glass, and we have a full faith in the glass that in the times to come, the glass industry has to grow multiple times. Even in India, the glass is being used at a very low per capita consumption. If I talk about the number, it is not even 20 kg per capita against, 1.8 kg. I'm sorry with the number. It is not even 2 kg on a per capita consumption. And our counterparts like China and other, they are already in the high two-figure numbers, like somebody is on 15 kg, 20 kg, 50 kg, 80 kg. So these are the number of the glass which are prevailing across the world. But in our case, it is less than 2 kg. So we hope so that the case is going to grow very, very fast in the times to come.
Right. Right. So overall, from a capacity perspective, your utilization is already at 96%.
Yes.
How is the capacity going to pan out after the acquisition of Hindustan National Gas? When will it be done? Because the matter is still now pending before the NCLT.
On the acquisition side, this whole matter is in the court. NCLT has to give his verdict, and some part is already in the Supreme Court. So it may not be a right way to comment anything on the acquisition timelines or way forward. But yes, we hope that everything will go very, very fast, and we hope to achieve this issue very, very soon. So we are hoping to come as soon as possible. So that is one part. But as far as the capacity is concerned, I think they are almost double the capacity of what we are. And we hope that by adding up, our numbers will certainly going to multiply accordingly. But this HNG is not in good shape because their capacity, they are running at under capacities. So obviously those capacities had to be corrected. This plant has to be corrected to bring it to the optimum level so that the whole value can come in the system.
Right. So my question is, if we don't know what the timelines could be as of now with regards to Hindustan National Gas, I beg your pardon. What is the plan B with regards to increasing capacity?
See, one is they already have the inherited capacities are there, and there is some dormant capacities are also there. Because whatever they are running at some particular percentage, maybe around 60% or 65% percentage of their total capacity. So one is the capacity which is closed, we have to start that capacity. So that is the hidden capacity, dormant capacity, and the closed capacity which we have to start. And thereafter, the glass is certainly growing at 5%, 6% on a minimum side. It can grow even at 8 to 9% when the economy will pick up in the times to come. So with these numbers, certainly the Indian glass industry will be requiring a big additional capacities in the times to come on a pan-India basis. So we hope.
So I'll interrupt here, but here on the acquisition perspective, how is it going to be funded, number one? And if there is a debt that will be taken for the acquisition, how will it impact the bottom line from an interest cost perspective?
Certainly, those once the acquisition is done or during an acquisition, there are some debt and there is some equity and there is some internal accruals all put together will be put up to cover up the total fund requirement in that acquisition. So that is one. So once those numbers come in the picture, when the debt number come in the picture, obviously it's a pure mathematics that the numbers which is visible to the balance sheet of AGI will get skewed from one side to the other. But then it's a matter of time only when everything will fall in line and the company start performing well. I mean to say the total joint company performing well. The numbers will change to the best possible numbers what we are showing today of the AGL. So that is the synergy which is going to come in the system.
Right. And my last question is overall, what's the outlook that you're looking at? And secondly, on the back of the utilization, taking into consideration that Hindustan National Glass has an EBITDA margin is around 13%, whereas you have a margin of 22%, right? How will that pan out? Will the company's margin consideration take some time for the margin of Hindustan to catch up to that of AGI?
In a margin side, there is nothing great can be done on the sales side. Of course, by adding some value-added products and new items and new areas and new segments we can enter, and certainly our revenues can increase. But the more is on a synergy side, more is on the cost side, and more are the best practices on the manufacturing side, which already we have been doing it and which we are going to do after the acquisition. So we have a full faith, we have a full confidence on the best practices, on the manufacturing practices and the cost reduction activities, whatever we have been doing, and we have been great successful because our numbers are showing in our balance sheet those success numbers are there. So those will be certainly going to be implemented. And we hope so that the joint entity is going to bring much greater value, not only to us, but to the whole country, because this is an area from where the exports to the other countries, to the Western countries will also start flowing. And because of the geopolitically, India is on a well-placed area where the things will start flowing from India to the Western countries. So I hope so that in the times to come with a joint entity, we are going to grab this part of the market also in a big way.
So last question, a quick one. We're running out of time, Rajesh. A little over 600 crores is what we've done in a seasonally weak quarter. Say around 2.5 to 3,000 odd crores is what you're looking at in terms of FY24?
Absolutely.
Right.
Mathematics at least suggest the same thing.
Yes. All right. Thank you so much for speaking to us at BQ Prime. And I think a good growth story that could be in the making, and a few of the months which are the strongest from here on as well. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BQ Prime.